Hey, good afternoon. Hope you're having a great Thursday, and I hope you had an amazing Labor Day weekend. We've got a big jobs number that came out last Friday, so we're going to break that down here a little bit in this week's update. Although we had a little shorter week in trading, definitely some movement to say the least. And then we're going to wrap up with a great question of the week from Diane about how to use automation in personal finance. So, really good question, especially with all this AI and technology talk lately. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, the data, the trends that we're watching, and hopefully weed out some of the noise along the way. So this week is a bit of a continuation from last Thursday. And I want to start just kind of right where we picked off. Last Thursday, we talked about some of the inflation numbers, the jobs numbers, and more importantly, what that may mean for the Fed. This week, I want to pick up right there and start with non-farm payrolls because that was a big data point that came out last Friday. For those who tuned in last week, you may remember that we were looking at the ADP employment report, which showed for their numbers, let me put it that way, a much, much lower number than they had been showing the last few weeks. Now, for those who do follow us weekly, you probably remember me saying time and time again that we don't want to take that too heavily because the non-farm payrolls number is the one that's maybe a little more descriptive or maybe a little more telling. However, that number certainly got some people talking. We touched on it last week, especially with the job openings number coming down. And then we fast forward to Friday, and non-farm payrolls came out, and we added about 187,000 jobs. So if you look at those two numbers, again, with the ADP employment drop, the concern was that maybe non-farm payrolls was going to drop significantly. That's not necessarily the case. So, kind of continued in the same realm anyways as some of the previous previous jobs reports there. But again, it just shows this confusion with the ADP employment report. So just kind of take that with a grain of salt when we talk about the ADP employment, and really the focus maybe a little more on the non-farm payrolls. In addition, unemployment ticked up on Friday, so ticked up to about 3.8%. And then, of course, we had the holiday weekend. So Monday was Labor Day. Markets were closed on Monday, so a little shorter week here in trading. But as we jump in, we came out with Thursday today. We have initial jobless claims came out at about 216,000. And get ready because a lot of the Fed presidents are talking kind of throughout the day and into next week, obviously, as we gear up for the upcoming Fed decision and press conference to follow. So coming up next week, be sure to tune in because we're going to touch on the last CPI data report before the Fed decision, the last PPI, Producer Price Index report before the Fed decision. So both are inflation measures. And then, of course, retail sales coming out next week there as well. Before we move back to the inflation conversation, I want to touch on a great question, from Diane, asking what are the ways that folks can use automation or maybe even AI, since that is the topic of the day, in retirement planning and really, with the lens of maybe how do we automate some things in our retirement planning. So what I will share as a starting point to this is that the reality is any sort of investment, retirement planning, tax strategy, I mean, everything that we focus on, the reality is they should all be tied to your individual needs, okay? Not one person should have the exact same answer all of the time, okay? So keep that in mind. That said, once you know what your needs are, that is where I think automation can really be used strategically, and maybe even AI to some degree as well, right? Some of this stuff could certainly be used for projections and some of the simple planning kind of topics that are addressed. But again, it's important to know where you're going and what you're trying to accomplish before implementing any of this automation, because otherwise we're just kind of like throwing money out with no name or purpose for it, right? We want to make sure we know where we're going, and then we can back up and say, okay, what do we need to get there? How do we use automation to make it happen? So there's a couple things I want to touch on here. One of the biggest things that I think automation can help with is a concept called rebalancing. So in other words, as your portfolio changes, right, every day, every year, every month, as markets fluctuate, your portfolio does as well. If you start with 60% stocks, 40% bonds, and stocks do really well and bonds either don't or just stay stagnant, you can imagine over time your stock portfolio could become worth more than 60%. So what rebalancing does is it's a tool to just say, hey, let's take some chips off the table and make sure we're kind of staying within that allocation that we had set up. So again, there's some nuances there for sure. The timing of it depends quite a bit, but a lot of times your 401ks or some tools out there may allow you to kind of automatically rebalance quarterly, annually, whatever you think may be best. Second, I would suggest is maxing out your 401k. So if you are in contribution mode, your 401k should have a feature that allows you to kind of constantly keep up with those changes in limits, right? Every year the IRS comes out and generally increases what we're able to contribute. So using that feature within your company's 401k, if you're contributing, would be really important as well, so that you're setting up an automatic increase each year. The third thing I would touch on would be kind of in a similar vein, but is automating your savings, right? If you're putting X amount a month towards a cash account or a brokerage account or an IRA or a Roth or whatever it is, rather than doing it as you can, assuming you qualify, doing it on a monthly basis may help you as well. Kind of that out of sight, out of mind idea. Third, I will touch on, fourth is income driving your distributions. So this is actually really important. I think if you are closer to retirement, the game shifts quite a bit as we get there in your investment strategy. Prior, it was all about accumulating, grow, grow, grow. When you get to retirement and you no longer have a paycheck being created for you, you've got to create that for yourself out of your portfolio, right? And so a way to do that is to use income generating assets, whether that's bonds, stocks. That part I don't really want to touch on for today's purpose, but consider how much money you need from your portfolio, and then consider how you allocate that portfolio so that you can drive that income to you every month, every year, without having to just sell or just like take distributions from your 401k. This is a little more easily done in an IRA because those dividends can be paid to cash or something along those lines. Which brings me to my last point. The fifth is creating buckets. So again, if you are in retirement, especially, when you make that shift, there's really three buckets that we typically talk about. One is kind of a cash bucket in your investments. So this is what you need every month, every year to live on. And the idea is if we have enough cash, ideally we never have to sell to create for that paycheck or the lifestyle that you want to live in retirement. The second bucket is meant to refill the first bucket. So this is the income driving part of it, right? This is maybe your bonds, the stocks that pay dividends, whatever it might be. And the idea is ideally that matches up with what you take out so that every month as you take money out, it refills the coffers. And then third would be your more aggressive bucket, maybe more stock focused, where this is meant to keep up with inflation and kind of prepare for the long term. So hopefully that's helpful. Again, there's 5 things I really touched on: rebalancing, maxing your 401k contributions, automate your savings, creating income to drive your distributions, and then the bucket approach in terms of creating that income and kind of that longevity factor. I hope that was helpful, Diane. Thanks so much for sending that in. I think it was a really good topic, but we will look forward to seeing you all next Thursday. Again, next Thursday, we'll touch on inflation and a little preview to the Fed meeting coming up the following week. Have a great weekend. We will see you next Thursday at 3.